Good evening, everyone. How's everyone doing this Wednesday evening? Thank you for joining me, Robert Cruz with the Lutz & Cruz team here at Ontario Real Estate Services for our weekly Silicon Valley market update, where we share with you what you need to know if you own real estate in Silicon Valley, and especially if you're considering buying or selling in the near future. A lot of things going on out there in the market. June data is in. That's half the year. And unlike what it feels like, 2020 doesn't have 89 months. It's only 12 months. So a lot has gone on in those first 6 months, which is a dramatic understatement. But good time to sit back and look at what has happened since January through June, and what can we expect in the very near future here in Silicon Valley. As always, I'm here with my partners, Carol Cruz and Kenny Lutz. They are standing by. If you have a question, please share it in the Q&A section. Carol will read it to me, and we'll try to answer it live if appropriate. And then in a little while, we'll bring in our partner with Prosperity Home Mortgage, Rochelle, who is standing by. She's got some cool information for us, and I think some really actionable information for homeowners out there in June of 2020. So I'm gonna go right in. I'm gonna do the structure a little bit different this week. I'm going to try to hit the most important information for buyers and sellers out there that are listening in, either live or in the recorded version. So you don't have to sit through all the data if you don't want to. If you are a glutton for punishment like me and like all the charts and graphs, you can stick with us to the end, and I'll show you some of the updated June data for Santa Clara, San Mateo counties, and other important information that I think is relevant. So with that, let's jump right in. I want to start with this, really what is kind of drowning out everything else in our market, and that's the idea and where inventory is in our markets. It's very important, very central to what we see happening around us with prices, with availability, with affordability. And one source that I always love to check on every week, if I can, is Mike Upate. And he shares this with us this week. The idea that inventory levels are down 20 to 40% across US markets. And he says, there's a reason I've been talking about new listing volumes as the best lead indicator of the health of the real estate market. And that reason is now clearly manifesting. There's a precipitous decline in available inventory across the US. Less new listings lead to less inventory, and that leads to causing supply and demand imbalance. If you tuned in every week, we've been talking about that. That's one of the things that we share with you every week, these leading indicators with so many changes, so many things that are kind of putting a monkey wrench in our typical year over year and month over month readings. These new leading indicators are very important and actually proven very accurate so far. So we're going to continue with that. And we're going to talk about, we're starting tonight with the inventory and how we have navigated through the first 4 months of SIP orders in Silicon Valley. And the idea that after that inventory disappeared in March, it made a strong comeback. And while it continues to rise, the pace of that recovery has slowed, something that I warned about in the last 2 weeks, if you were listening. And while this information is nationally, regionally, and locally, it's not the only factor affecting us right now, and especially in our local market. So we'll talk about that going forward. And just as you can see here nationally, and we'll show you a little later, it correlates locally too. We had that massive dip in new listings, both in total and year over year. We had the recovery, and that has felt good. That has driven our markets. It's made everything really, really hot last part of May, all of June. But we did not reach 2019 levels overall, and that pace of increase has started to slow down. And what does that look like? What does that look like locally? Here is the data for Santa Clara County. To show you what is happening week over week and month to month here in this county. I'll share this information for San Mateo County later, but we'll start with this just to show you the trajectory and what we can expect in the coming weeks, right? So we see here for 2020 that the numbers have really increased. I'm going to try to figure out how to use a laser pointer here. We've seen the year-over-year changes in inventory. Active single-family residences dropped 32% year-over-year, while the pendings have risen 7% year-over-year. More importantly, and more pertinent to pricing and affordability right now, is how it's moving within the year. And we see here that actives have recovered nicely from a very low start. A lot has happened in between, but big picture is still up 143% year-over-year, and pendings have recovered and have almost caught up in the year-to-date category. The last several weeks, this number has been far stronger than this number, so this should surpass the active increase. As we can see, the absolute number already has surpassed it. So going back to that low inventory, pressure on the ratio between supply and demand, this is creating tremendous pressure on pricing throughout the county, and it can easily be seen here. So despite the massive disruption that COVID has caused, we have learned a few things. We can still buy and sell houses, even during a lockdown. Even before we were announced as an essential service, we were still selling houses. So we know that now. And that's important as we start to hear news of a resurgence in COVID cases, some slowing down, some reversing in stay-in-place orders and reopening our economies. That was quite scary in March because we didn't know what that meant. We didn't know what that looked like. While I don't want us to go backwards, I'm confident and comfortable that if we do reinstate stay in place at any level, if we do slow the reopening, we know we can sell houses. We have found ways to do that. The consumer has found trust in the systems, and many have been rewarded with great deals. So all that is very good to know. We also have learned in these last 3+ months that low inventory, low interest rates, and a strong economy put upward pressure on prices. Historically low inventory and historically low interest rates, like we have now, creates even more pressure. But what about the economy? We will touch on that because we need all three. We need the low inventory, we need low interest rates, and we need a strong economy to push prices up. All right, so this is, I forgot I had the animation here. So just showing you again how that our low inventory environment right now compares to 2017. This is important, and we'll touch on this in a second, that sorry, I'm in a new room and it's boiling hot in here, so I am trying to get some fresh air in here. So the numbers are increasing, very similar to 2017. Why is this important? If you're looking to buy or sell in the near future, you want to look at trends, you want to look at similarities in the market so you can see how that works. And what I've been pointing out to you that have been watching for the last several weeks is we're entering a period where the rate, the number of active properties and the rate of pendings is mirror matching what we saw in the summer of 2017. Why does that matter? Low inventory, low interest rates in that period created a really superheated market in the spring and the start of the selling season in 2018. So I'm very curious to see if that trend continues and we see that go on to the point where we have a market in early 2021 like we did in early 2018. And again, you can just see here, all the conditions are very, very similar. This is not me telling you that this is exactly what's going to happen. This is me telling you the conditions in summer 2020 are the same as the conditions in summer 2017. And as we track and watch over the next weeks and months, we'll see if those continue. And if they do, we'll know what happens in the spring. We'll know what happens this fall. And this is hopefully why you're listening to us this week and every week. All right, so what did that look like? We can see that when we entered that really low, tight inventory period in 2017 and moving into 2018, we had a superheated market and we can see the pattern. So I pulled back here for the last 3 years, and this is sales to list price ratios, and I'll explain that in a second. we can look for patterns and we can see that the conditions that existed in the summer of 2017 are in place once more. That led to a frenzied market to start 2018. But that only lasted for 4.5 months and led us into a flattened market. Now, that market, that flattened market, we haven't seen it since that time period, but that market lasted from June 2018 through November 2019. After a long downward trend in inventory that started in June 2017, we were left with a cocktail of the record low inventory, low interest rates, and a strong economy. So here's what happened. We hit that period around May and June, and we hit the peak, and we were selling homes at a really inflated price, 106, 107, 110% over asking price. And that flattened market, it started to slow down after that late May, June period, and it trended all the way down to below 100% in late December 2018, recovered in that spring selling season, but stayed flat until this last November, December. So this is what I'm asking you to look at. If you're thinking of buying or selling the next quarter, the next 6 months, the next 9 months, we have historical data that can show us and give us a really good idea of what we can expect. So we established the baseline where we are right now. We look for similar periods in the past, and we can see the data as it trended up or down. Why does this matter? I'll remind you, if you were a seller in this period, your value still went up. So I don't want you to think if you're a seller that you're going to miss the boat somehow. If you were a buyer, what happened is the early part of the years, all cash, really strong, really motivated buyers that were willing to go in at multiple offers and win with high prices, all cash or a lot of cash, low to no contingencies, they won. If you were dependent on appraisals, if you were dependent and needed contingencies, you had to wait. But eventually the appraisals caught up, inventory started to last a little longer on market. You could be a little more cautious about how you wrote your offers. You did pay a premium because this activity early on drove the prices up. This does not mean prices fell. This means they did not rise as rapidly. And so that's where we're on the cusp of right now. We're still in this kind of period where we're starting to see elevated prices. We're starting to see multiple offers. We're starting to see the early days of a flattening market. So what I'm trying to point out here is whatever your need or want is, talk to someone that has this kind of data that can give you really pointed information on what your next move is. If you're a really motivated buyer, if you're really strong, if you have the cash positions, you will be rewarded by paying overall a lower price. If you can't compete in this environment, you may have to wait a couple of weeks, a couple of months, and you can go in, be a little more discerning, be a little bit more cautious. You will pay an overall higher price, but that's a trade-off sometimes. If you're willing to give up some comfort, some ability to keep contingencies in place, you will pay a lower overall price. But if you need or want that comfort, your time is coming. And that's what we want to really focus on for everyone, no matter what you need, no matter what you want. If you really understand the data or talk to someone that understands it and can share it with you, you'll be in a good spot. All right, so that's what that looked like. Then here's what we see now. All right, this is the latest information. Single family residences in Santa Clara County, active properties. You can see the decline from our peak on around June 8th has continued to decline each week. This is normal. Again, usually this peak is around May, late May, early June. It lasted a little bit longer this year, or actually was delayed after the stay in place. But now we're kind of, although delayed reaction, we're kind of into our normal trend. And again, over here on the pendings, you see they are rising. This usually doesn't happen. This is when they usually start to drop, but we're adjusting for COVID. We're adjusting for that kind of 4-week window where things were kind of unsure. Things dropped overnight, and now we're in that recovery mode. If you're in the market right now, this is what's the most important point. The pendings have surpassed the actives, really putting a tremendous pressure upward on prices in our county. Again, you see here something we covered a little bit earlier, trending overall, just like 2017, pushing into a really hot start in 2018, a flattened market throughout. The big thing that we have to watch, I'm convinced and I'm positive we're going to remain in a low inventory environment the rest of this year into 2021. I am convinced and I'm positive we will remain in a low interest rate environment for the rest of this year and into 2021. The big question mark right now, frankly, is our economy. What is it going to do? I'm going to share in a little while. We're starting to see some bad news creep in, or I won't, not necessarily bad news, but maybe tempered good news. After the last 3 or 4 weeks where everything has seen, we're back, we're on fire, we're rolling. Some of the forward-looking economists have started to see some chinks in our armor and some problems, and that could affect our real estate market. So we'll cover that in a second. All right, so let me go into what's going on with, hold on one second. I think I made a mistake here. I'm gonna have to stop the share for a second, and I'm going to go into why I'm not showing the slides I was expecting. Hold on for a second for me. I'll be right back in 1 minute. It's not showing the slides I'm supposed to show. All right, I figured it out. All right, here we go. Sorry about that. Always something new when you're dealing with these slideshows. I can't do it. All right, am I sharing the screen now? Perfect. All right, here we go. All right, so what we see here, this is what I was a little tongue-tied because I was expecting the slide to come up and it didn't come up. So let's get back on track here and sharing with you what's going on out there. What are the experts saying? What can we expect? And this is what's really what I was talking about, where there's starting to be some negative news. And this is from CoreLogic. If you're not familiar with CoreLogic, it's a great resource to go and find information on what's going on in the market. They do a great home price index. And what they're showing right now is that they're expecting in the near term, they're expecting prices to rise for the rest of this year, but then they're forecasting a drop in the beginning part of 2021. Why are they saying this, right? So this is a quote from their chief economist. Pending sales on home purchase loan applications are higher than in June of last year and reflect the buying activity of millennials. By the end of summer, buying will slacken and we expect home prices will show declines in metro areas that have been especially hard hit by the recession. That does not quite apply to Silicon Valley, but we will show you where some of that is happening here. Overall, the anticipated impacts of the recession are beginning to appear across the housing market. Our market here has been so strong that we forget that some economists have already put us officially into a recession. So always remember that. Eventually, if we have a national recession, it does affect us locally eventually. Despite new contract signings rising year over year in May, home price growth is expected to stall in the summer. CoreLogic HPI forecast predicts a month-over-month price decrease of 0.1% in June and a year-over-year decline of 6.6%. Now, I don't think that's going to happen here, and I'll show you why in a second, but that is important to note. I trust CoreLogic. I like CoreLogic. These are national numbers. We always have to recalibrate for our local markets, and I'll show you what I mean by that in a second. Further, they say home purchase activity, bolstered by record low interest rates, continues to exceed expectations despite the severe recession. Pent-up buyer demand was delayed from spring to summer and is reflected in the latest price data. but with elevated unemployment, purchase activity, and home prices could fall off after summer. That's where we're going to focus today on what those numbers mean and how they could affect us in the near term. I like what they write here. Unlike the Great Recession, the current economic downturn is not driven by the housing market, which continues to post gains in many parts of the country, and especially here in Silicon Valley. And while activity up until now suggests the housing market will eventually bounce back, the forecasted decline in home prices will largely be due to elevated unemployment rates. We touched on this last week, right? And we said, rightfully, that the markets and everyone was really happy when the latest unemployment numbers came in and they were only 11%. And that's down from 15, 60%. So that is a great number. But then as you kind of let that soak in and you realize, wow, 11% is high. No matter what anyone says, that's a high number. And when we got used to low threes, low mid 3.5% for so long, that's an even higher number. That's almost quadruple what we've gotten used to. And so reminder, low inventory, low interest rates, great for our local real estate markets and helping and growing home values, but it requires a strong economy to maintain it. And we're starting to show some cracks there. All right, so the economic news, a little bit further into it. I pulled this from Goldman Sachs' latest report. And they write, the U.S. is now a notable outlier among advanced economies. And they're talking specifically about our reaction to the COVID virus and how we have still elevated cases and how we've had to, in some places, reverse or slow opening up of our economies. That is long-term not good news. That is bad for consumer confidence. That is bad for real-time productivity. And that could affect our recovery, slow or exacerbate the rate of recovery in unemployment and other factors in our economy. So in the past 2 weeks, states representing about 60% of the US population have responded to the worsening virus situation by pausing or reversing their reopening plans. Not yet anything to be afraid of, in my opinion, especially when we're talking about real estate in Silicon Valley. We still remain an outlier in our local economy. We still remain an outlier in minimal job losses. Our tech-driven economy is still humming along very, very strongly. But if you've ever heard the saying, when California catches a cold, the rest of the nation catches the flu, that can work in reverse too. If the rest of the nation is not doing well, eventually that is going to affect us. So it is a longer term outlook. Near term, we're still looking really, really good. But again, I want to give you a really, really in-depth look at what's going on, what can affect your decision to buy or sell, what you need to know to make the strongest decisions possible. So I won't spend too much more time on this. I just want to make sure that you're aware that these numbers are there. It's why we track these things each week. We're going to know in real time if these things are actually affecting activity locally, if they're affecting pricing locally, and you'll know before anybody else when you continue to tune in and call us for information. All right, so again, I'm always a big believer in our mortgage markets. I know, I'm very proud of being a realtor, but I know realtors don't do anything without lenders. And so this is why I always point this out to you. And here's where we're going to start to see what I'm talking about real time. Very strong recovery, still doing really well year over year, especially after that long pause through March and April. But as you can start to see here, purchase loan rate locks, which have been a very, very efficient way of predicting what happens next. You can see here in the line here, still far above 2019 activity. However, what we also notice is we seem to have reached a peak about 4 weeks ago, declined, and now flat over the last 2 weeks. So this typically would not be bad news, except that we had such a dramatic pause for such a long time. And we had inventory and transactions that were missing from March through April and May. In order to recover fully we needed this to stay up in this level for a much longer period of time. That does not mean that we can't be surprised and it can recover and go up even higher in the next coming weeks. Again, this is why you want to track week to week. But when we get to the numbers, the local numbers, you're going to see this is playing out in our activity for buyers locally and can have a dramatic effect. The other thing we've been tracking again is this idea that because of COVID-19, or maybe it's not because of it, but it's just happening at the same time, this move from buyers away from more urban areas into suburban areas, away from the urban core and into non-urban, it continues to be seen. This is, I think, the fourth week continuously that we're seeing this pronounced change, more purchase rate locks in our non-urban areas than our core urban areas. As I said last week, this can be a little misleading because this is a rate of increase over last year, but overall, still way more people looking in our urban core than our non-urban cores. So I think it's significant enough to share with you each week as you make decisions. And part of what we're trying to say here is we show you the regional, the national, but eventually you're going to make a very specific decision about buying or selling in a neighborhood, in a city. And we don't always have the time every week to drill down into those neighborhoods, into those cities, but this level of analysis can go that far. So once you see the lay of the land, where you see these meta movements, reach out, give us a call. We'll share with you the local data, the neighborhood data that coincides with this to see if you're making good buying or selling decisions. Finishing up here, you see again what I was talking about in San Jose, San Francisco, Oakland area. The most robust areas of growth are in fact in the least dense areas. You see that last year, the least dense areas, 6.1%. This year, 43% growth year over year. But as I mentioned, that still only accounts for 7.2% of the total share. Okay, so if you're thinking you should move there because everyone is moving there, that's not true. Everyone's still staying in our core urban areas, but there is a shift that's noticeable enough to share with you each week. But reach out to us, ask us if you're thinking of our outlying areas of Silicon Valley. We can share this information with you for those local markets. All right. So another point that really caught my attention this week was this idea, and I asked Rachel to talk about this a little bit. I'll introduce it and then I'll give her the floor. There is a record amount of home equity in our country. Not surprising with when we've seen our markets recover so fast and so consistently since 2010. Values go up and up and up. And what's different is in past cycles, when after a down period in real estate and real estate values recovered and equity grew, homeowners immediately would tap into it. They would draw out that equity, at least part of it, through either cash out refinances or home equity lines of credit or other means of tapping into that equity. They are not doing that now. Maybe it's too soon after the last debacle in 07 and 08, and the consumers are wary about using their houses as an ATM. And I understand that, and I think that's prudent, but there is something hidden in those numbers that I just don't understand, and I want to talk about it because we really always want to help the consumer out there, and it's this. More than 75% of homeowners with tappable equity have mortgage rates above 3.5%. Tappable equity means that there's enough equity there that if they were to refinance into a lower rate, there's still 20% buffer there. So it's not even using all of your equity. But these record equity levels allow people to go in, and if they are not in that 3% or near it, I think everyone owes it to themselves to call someone and ask, can I get a lower rate? Don't have to take cash out, don't have to sell your house, but my goodness, if you can save $50, $100, $200 by lowering your interest rate right now, you should do it. It's long-term, it's easy, and this report shows that in their estimate, the majority of people, or a good number of people, could actually do that and although there are costs associated with refinancing, they could still save money. So with that, I'll turn it over to our partner, Rochelle, and see if she can give us any more insight about what's going on and how she can help you save some money right now. So Rochelle, if you're ready.
Good evening, everybody. Thank you so much for joining us. Grateful to be here. And like Robert mentioned, right now with record low rates, it's a great opportunity for clients to leverage refinancing their homes. And there's a number of reasons why you want to do that. A couple of them, of course, the obvious. It's an opportunity to secure a lower rate, which helps save you money. And again, if it's $50, $100, reach out. I'd love to do a scenario with you to see what it looks like specifically for you, but every bit counts. And recently I helped a family that's saving over $400 a month just by refinancing, not pulling any equity out, but their rate was so high, it was an opportunity for them to leverage. So stories like that are happening every single day. You may also want to refinance to shorten your term on your loan. So perhaps you had a 30-year fixed, and rates have dropped significantly. You're in a position to be able to maybe pay more. Let's talk. Maybe there is an opportunity for us to shorten your term and you can pay down your loan quicker. So another exciting reason why people want to refinance is for a lot of individuals, they purchased a home and had an adjustable rate. And with rates is in the low threes and in some cases even the high twos, it's an opportunity for us to lock in. Again, it's that insurance policy against your home. We're drawing a line in the sand that from here on forward, your payment's not going to go up. So we're securing that in. And like Robert mentioned earlier, there's a lot of equity in your home. So perhaps it's an opportunity to maybe do some home improvements, perhaps put some money aside. I always think equity is like a spare tire for your car. You never know when you're going to need it. So it's an opportunity to perhaps pay off some debt, have in case of an emergency fund. But again, there's so many different reasons why you want to leverage not only the equity in your home, but perhaps a conversation about refinancing and if it's the right thing to do. Again, we touched on if your interest rates 3.5% or higher, or even challenge you. If it's even 3.5% or even lower, reach out. Let's do a side-by-side comparison and see what we can do to help you. And lastly, it does cost to refinance, but the whole overall value of refinancing may outweigh that. And again, we're here, lean on us. We're here to support you all. And thank you so much for having me on today.
Thank you, Rochelle. And I want to point out, the reason this number caught my attention was when you work in real estate or you work in lending, we talk about it and think about it all day long, every day. And we somehow feel that everyone out there thinks about it as much as we do. And this number proves to me that we don't. And we've been talking about low inventory environment right now and how low inventory is. And we're going to talk next about how that can impact our markets. And I'm convinced that a lot of homeowners that are thinking about selling don't understand that it is in fact possible right now. It is in fact very profitable right now. And just like it doesn't make sense to me that someone that could pay less isn't by these numbers that Black Knight reports, it occurs to me that some homeowners that are thinking of selling might think that it's not a good time, might think that there's no way you can properly list a home and get maximum value right now. And that's why I wanted to point out this fact, one, to help some of you that aren't aware and could get into a very nice position and lock in your interest rate for the rest of the time you own your home and create a lot of savings. But two, just reiterating that I don't want to assume that because we know it and talk about it all the time as professionals, that the consumer knows it. So want to reach out and make sure if you're listening, you know that it is a good time to lower your payment. And potentially, you know that it is a good time to sell or buy a house. So that's what we'll talk about next, right, in our Silicon Valley update. So here we go. Another thing that I've been sharing with you each week is the lead indicator of showing time. And we talked about in the last several weeks how that has peaked and it started to drop. I will remind you, if we're going to give good news, we've got to give bad news. And when we were very positive throughout this period from mid-March through April of showing these numbers coming up, going faster, going up, and it translated into really positive sales, rising values, really robust markets, then we have to understand that if it declines, there's a potential there for those headwinds too. So I don't think this is strong enough or a long enough trend to drop prices, but it can serve, if it continues at this downward or stopping the upward movement, can help us reach a ceiling in prices. And that's important for us to understand. So keep that in mind as we go along. Here we see the new homes listed 2019 through 2020. And we clearly can see here in the last couple of weeks that that 2020 number never quite reached the 2019 number. We did feel the effects of the rise after showings resumed. And we did pass it in the last couple of weeks, but it immediately started to drop. As long as it stays above 2019 numbers, I think that is okay. It would have been nice if it continued that upward trajectory for a much longer time. And again, that can happen in the next couple of weeks, but generally it doesn't happen, and that can affect what we're going to see in the next few weeks. So will new home listings remain above 2019 levels as they have been for the last 2 weeks, or will they regress to normal patterns of dropping off quickly from May highs? And while they're usually May highs, this year they're June highs. In going back the last 10 years, I can show you, you can see very clearly the pattern. New listings peak in the second quarter, decline slightly in the third quarter, and then go all the way down into the third and fourth quarters before they recover the next year. This year, we did not have the bump we usually see, and that's creating that low inventory environment this summer that could create the possibility of a really heated market next spring, again, if our economy cooperates. Closed sales for 2019 versus 2020, again, you see the nice rise here, but although it remains a positive trend, it can only be maintained if we continue to bring new listings to market. It's a truism, and it seems painfully obvious. We cannot sell what is not available in the market. So we need to see those numbers increase. And I really hope if you're out there thinking of selling and you just were thinking that it was a bad time, this can show you, these numbers can kind of, at the very least, reach out, give us a call. We'll walk you through the numbers and show you why it is a good time to sell. Change to pendings, again, remaining a positive trend, but shows that the resurgence that started soon after SIP was ordered, as you can see the trend up here, may have already peaked and would be a leading indicator to a flattening in the market. Those pendings have slowed down dramatically. What are the actual numbers? Here we go for Santa Clara County. As I said, the June numbers are in. Overall, still very positive, and we'll take anything above where we were, certainly in March. But here's what I've been focusing on today and what I want to finish with in the last several slides here. Pendings are still really positive. The May to June change, a 25% increase, really good number. The new listings, flat, only up 3.9% from May to June. And as I promised last week, we had bad sold numbers for May. The June number popped, up 71%. Early days, first week of July, pendings are down month over month for the same period. New listings down month over month for the same period, and the sold has slowed down. Now, if you've been watching every week, a 1 week in a month is usually nothing to worry about. But what we have seen in May and June is these 1 week, 2 week, 3 weeks into a month have shown us the trend for the remainder of the month so far, month to date. So again, this is not worrying me in terms of prices falling. This is not worrying me in terms of making it a bad market, but it is showing, again, a flattening of the market. The rate of acceleration in all three areas has flattened, and there's not a lot out there showing me yet that it's going to increase dramatically. And this is the most important number. If we don't increase the number of listings, the pendings and solds will not follow. If they maintain a proper ratio, we still have multiple offers, we'll still have rising prices, but the rate will decrease. I'm still not comfortable using the days on market numbers because of that period in March and April when they were not being recorded. So maybe by the end of July, we'll focus more on it. But here's where the last three things that I want to share with you. New listings, again, very flat May to June, and the first 7 days of July, negative. What does that mean? Here's where it's all at. I've been focusing heavily in this sit period on the absorption rate because when we don't have a traditional or normal amount of inventory, I don't trust days on market numbers. I don't trust that inventory reading. So I want to judge how hot is the market based on what do buyers buy of that which is available. And that's a very layman's term of explaining what absorption rate is. If you've been listening, you follow and you see. What we saw in May to June, again, really strong recovery in all of Santa Clara County, a jump from 71% to 92%. From the lows in March, which really were, April, where really were March numbers, we saw a strong recovery, big bounce back up. And this is the heat we've been feeling in the market. This is that rapid return, these multiple offers, houses only lasting a week to 2 weeks, for going for way over asking price, all of these headlines you've been reading. Always under the headlines is the data. And that's when you're really paying close attention, what will allow you to make smart decisions going forward. So if you're still reading the market based on the May and June numbers, you need to understand that so far, again, July, still a great market. 79% is a great number for sellers in any market in any period. But again, that dramatic jump not only slowed down, it has reversed. It is down to right around right here. Again, a buyer's market is around 15 to 20%. So don't start thinking you can go out and get a bargain for a house in Santa Clara County. You're still going to pay a premium. This is what I was referring to you earlier. If you were priced out, or if you were looking in May and June and you weren't all cash, maybe you weren't in the strongest position and you were worried about the home appraising and you had to be very conservative and therefore were losing on your offers, this is the period when the market catches up. As this rate of increase slows down, what you missed out in May and June, you can be back in the market. This causes the flattening. It's still healthy, it's still strong, but some buyers that experience buyer fatigue in May and June can now return into the market. I will caution you, you are paying more for the same house in July and August than you would have in May or June. I'm not telling you that the prices are lower. I'm telling you, you can compete if you were not that all cash, heavy cash, no contingencies, all in buyer. Those buyers were smart, in my opinion, because they paid a lower price. But not all of us are in that position. Not all of us can be that aggressive in the market. Our time is coming. Your time is coming. If you want to understand this better, give us a call. Let us explain to you what your local market's doing. Where are you looking to buy? And I'll share with you next week. I'm going to dig deeper. I'm going to pull out a couple of specific zip codes and markets that are touching each other within the larger county data. And I will show you sometimes jumping from one side of the street to the other dramatically changes what you're doing. And I know that buyers, for example, in Santa Clara County, are not looking at one price point in one area of the county. It can dramatically change from Palo Alto all the way down to Gilroy. Even in the greater San Jose area, you can be looking 2 or 3 miles away, and there are dramatic differences. So this is what I want you to understand. This is what I want to share with you tonight and encourage you. If you're in the process of thinking of buying or selling, we'll give you this kind of high-level data so you can see the overall trends. But we really want to engage with you and talk to you about what your needs are, what your wants are, where are you looking, what is your timeline, what is your ability to buy, what is your ability to buy in the areas that you are interested in. And we can do this really high level drilling down of information to help you make the best decisions for your buying and selling needs in whatever area, whatever neighborhood you are looking at. So that's all I have for you this evening. Overall, still very positive news in my estimation. Still a very strong market. July, I think, will remain hot, no pun intended, throughout the month. The rate of increase is slowing. That is really important information for those of you looking to buy or sell in the next 3 to 6 months. What does that mean for the long term? How will our economic recovery affect these things? Again, I'll finish. Low inventory, super low interest rates make for pressure on prices as long as the overall economy is strong. To date, it has been. We are seeing some headwinds. By the time we talk again, we might have more unemployment numbers. We'll have more indicators of where the economy is heading, and we will see how that will affect pricing in Santa Clara County, in Silicon Valley, and in the neighborhoods that you're looking for in the coming days and weeks and months. So again, I think we flashed our phone number at the beginning. If you have any questions, if you have any ideas, you can reach out to us. You can reach out to me at robertcruz@entero.com. Either I or one of my team members will reach out to you. We can schedule a one-on-one. We can schedule this kind of high-level view of what's going on in the market so you can make the best decision possible. All right. Thank you for your attention this evening. Hope you're having a great week and month, and we will see you again next week. Thank you.